Welcome to Grace Financial Services. I'm Jim Massey, and it's great to have you with us today. I'd like to take a few moments and just explain to you offset accounts. Now, naturally, as you think about somebody that wants to go out and to buy a home, they need to get a home loan. Money from the home loan is going to enable them to buy that particular home as they get a certain amount of money. An offset account is simply a savings account that sits alongside of the home loan, and it's associated with the home loan in such a way that whatever the balance that there is in the offset account is going to reduce the debt on the home loan by that amount, so that the interest that you get charged is going to be on the difference between those two accounts. So it's a great way to reduce the interest that you're paying on the home loan. But as you think about that, if you were to have paid that money directly into the home loan, you'd have the same result. It reduces the amount owing by that amount, which reduces the amount of interest that you're paying, and so you wonder, why bother? What's the big deal? So you think about this home. Let's say right now it's your owner-occupied home. It's a place where you live. With that, no particular tax implications, anything like that. But let's say you decide to upgrade from this to a larger home or home in another place, and you decide to keep the original home, and it's going to be an investment property. Well, as an investment property, then whatever money was used that was borrowed to purchase that property, it's associated with that property. Whatever interest that you're paying on that loan is an expense related to that property, and therefore is a tax deduction that offsets income for the property, and perhaps if it's negatively geared, even other income that you have. And so all of a sudden it's rather important as to how much of your debt is related to this property as to how much debt is related to that one. Now, if you had the situation where you didn't have the offset account and you just simply paid money into this account and it's reduced the balance by that amount, then it's just simply the amount that's remaining that is associated with this property. Because even if you borrow another amount secured by the same property to be used as a deposit to purchase this one and get your remainder of the money over here in a separate loan, this money here, even though it's secured by the investment property, it's used for the purpose of purchasing the owner-occupied property, your new home down here. And because of that, it's associated with this, and therefore the interest on that is not tax deductible. However, if you had that situation where you had the offset account over here, reducing the interest, and you use that savings instead of getting new debt, but you use the savings as the down payment, then all of this original debt remains as debt that's associated with the investment property, the property that's now an investment property. All of that is associated with it. You haven't paid that down at all, so you're not redrawing off of it. It's all money that was used to purchase that property, and therefore all of the interest that you're paying on it is tax deductible. Because you've used the savings as the down payment down here, the loan that you end up having to get is exactly the same, so there's no difference as far as the total amount of debt. The only difference is you have a lot more tax deductible debt having used the offset account. Let's say you're operating a business. And as a business, you need to have funds to operate with, and as a business, you find that your cash flow is very sporadic. In fact, this same type of thing would also apply to people that have commission income, or they might be professional sports people, or movie stars, or whatever else it might be, and they've got income that's very lumpy. Big chunks of income for a period of time, then a period of time with no income, and back and forth and that type of thing. Well, an offset account can be a very beneficial thing to have. So you've got debt, and this really makes no difference as to whether it's tax deductible debt or not as far as this particular aspect of things. You got debt, and with this debt, it's got certain obligations in terms of interest payments. Now, it might be interest-only loan, and the obligation is just simply to pay the interest on it each month. It might be a principal and interest loan, and you've got the obligation to pay the interest plus an amount of principal adding up to a fixed amount that's a constant repayment through the life of the loan. But either way, there's obligations, and those obligations come every single month. But your income is not coming every single month, so you wonder, well, how am I going to handle those load times and all the rest of it? And if it's just a standard loan, even though you've paid it down to a certain level and you're way ahead, you still have the obligation to make a repayment. Now, naturally you could, if it's got a redraw facility, you could draw money out of the loan and then immediately pay that money back in the loan and meet your obligation. But boy, that's a hassle. So, what happens if you got this offset account over here? Now remember, this is a savings account. So this has got a positive balance, that money you've put in there. And you perhaps start out with a certain amount of money in there. As money comes in through something you've done, work that you've done, business that you've written, you get income that goes in there. This rises up. It's reducing the interest along the way, so you're paying less interest. And you set it up to where the obligation for the loan payments are coming from that offset account. So the interest that's being paid every month is just coming out of the offset account. Well, there'll be some months that as your income is going in and being paid into that account, there'll be some months where there's more income than what's needed for the loan repayment, so this account will go up. There'll be other months where you don't get any income at all. This balance will go down, but there's still money there to keep these interest payments going. And what this allows you to do is it allows you to even out the bumps and the valleys and things like that in terms of your income, so that you don't have to worry about it. You just need to know that on the average, I'm going to be paying more into this account than what the obligations are in the home loan. So it's a very simple, straightforward way to meet those obligations and to not have to constantly be worrying about where's the money going to come from to make this great big loan payment that comes each month. So that's a couple of reasons why you might want to use an offset account. It can be very handy and can serve a very good purpose. Well, if you have other questions, please feel free to contact us. We've got an inquiry form on the website. And of course, the website is graceloans.com.au. You can find out all kinds of great information there about loans. Get in touch with us, see other videos with information, and a lot of helpful stuff. So it's great being with you today. I'm Jim from Grace Loans, and you have a great day.